once again to Dubai. So we're going to talk today a little bit about the subject of tax treaties, which is kind of ironic because countries like Dubai don't have a lot of tax treaties normally. So the reason for this is because specifically we're talking about double tax treaties, okay? So what's the deal with a double tax treaty? It's designed to avoid double taxation. So you sometimes call it a DTA or a double tax agreement. And these are specific, they'll talk about like a treaty for the avoidance of double taxation. So what would normally happen? What could potentially happen is that I have, let's say, we'll ignore Dubai for a minute because Dubai is zero tax, which is why they usually don't have tax treaties. Let's say that we're talking about between Canada and the US, okay? So somebody's doing business in both different places, right? Maybe they have a company that's from Canada, but they have an office or something in the US. So the US wants to tax them based on that office. That's a source income situation. And Canada wants to tax them based on the residency of the company. So what would happen in this situation traditionally is you would get taxed twice, right? You'd have to pay the US taxes at whatever the applicable corporate tax rate is, and then you'd have to pay the Canadian taxes at the corporate tax rate. And obviously that's very unfair and very inefficient and not good for anybody. So two things happen in these types of situations. One is very often countries will provide foreign tax credits. And what this means is that you basically get to deduct from the tax that you have to pay locally the tax that you paid foreign. So that's a unilateral tax. Unilateral means just one side applies it without having to worry about the rules from another. But in addition to that, there's also these treaties, okay? So how do these treaties work? Basically, this is an agreement that under certain circumstances, so common things in a tax treaty will be, of course, they have the definitions. They'll have terms of residency. So how do you know if you're resident in one place or another? And this is really useful if you're moving somewhere because it makes it quite clear. Very often, residency is an unclear concept, but here, by moving to one country, if you can look at the treaty, it will tell you the terms under which you're resident there versus here, and vice versa. Okay, so that's a very interesting point. Then what we're going to have different types of income. So for example, rents, royalties, dividends, potentially capital gains, director's fees, services income in some cases. You're going to have a situation for permanent establishments. So it defines what is a permanent establishment, and if there's a permanent establishment, so like as in the example I gave at the start where I said you have a Canadian company doing business in the US, it'll say, okay, well that's a permanent establishment, so here's how that gets taxed in these situations. You have associated income, you have things from independent sources, so what they call independent agents, and then sometimes you'll have a limitation on benefits clauses. So this is quite common where you have, for example, a tax treaty between Canada and the US, and it will say maybe Puerto Rico doesn't apply under there. The Australia-Malaysia tax treaty will exclude Vabuan, something like this. So you get a situation where it explains with a lot more clarity how it's going to happen. And usually these treaties follow an OECD standard, so that's the Organization for Economic Cooperation and Development. They set a standard for how their treaties usually are, and most of them are like that. US tax treaties very often aren't. They have their own standard that they've often used, and then you'll have older treaties that don't follow the new standards and things like this. You'll also get something sometimes called anti-treaty shopping provisions. So this is where it prevents a company from, here's an example. Let's say that I am in France and there's going to be dividend withholding tax, okay? And that'll be covered, what the rates are will be covered in the tax treaty. But between France and Malta, there's the EU Parent Subsidiary Directive, which means that there aren't going to be withholding taxes, okay? So, and then Malta doesn't have withholding taxes on dividends. So let's say that a company says, okay, well, rather than paying dividends from, let's say, France to Canada, they're going to pay dividends from France to Malta to Canada to try and avoid those, okay? So there might be an anti-treaty shopping provision that says, hey, you can only do that if, say, there's real presence with real employees and things like this located in there. And so, yeah, tax treaties or at least double tax treaties, which is the ones we're talking about right now, are really designed to give you a sense of clarity to help, in theory, avoid double taxation. And there's also something called tax information exchange agreements. This is for information exchange, and sometimes there'll be an exchange of information provision in the double tax agreement, and then there's countries that don't have taxes, so you get Bahamas, Cayman Islands, places like this. Usually they won't have a double tax agreement because there's no worries about double taxation, but they will have a tax information exchange agreement. And tax information exchange agreements have become much more popular because there was threats of blacklists and things like this for any country that didn't have a certain number of them, and so a bunch of countries went and signed them with other, tax haven type countries. Anyway, that's a little bit of an overview of the tax treaties. If you have any questions, you can contact us. Want to learn more, check out our other videos, and we will talk to you guys very soon.